An AI-driven earnings boom is colliding with a more hawkish Federal Reserve and a record pipeline of tech equity issuance, leaving equity markets at a delicate crossroads. This is vTalkInsight, Equity Pulse Daily for June 10, 2026. Today we unpack how that macro mix, sector rotation, and the coming wave of AI-related deals are reshaping equity risk and opportunity. Under the surface, the macro picture for equities is still defined by surprisingly strong growth colliding with stubborn inflation. On the growth side, earnings projections remain unusually robust, with aggregate profit expansion for this year expected above 20% and mid-teen gains penciled in again for next year. That kind of earnings momentum is being underpinned by one of the largest U.S. capital expenditure booms in decades, much of it linked to artificial intelligence infrastructure and broader reshoring themes. Recent U.S. labor data point to solid job creation and rising confidence, yet wage growth has not broken out. That combination supports a soft landing style narrative, where nominal growth stays healthy enough to feed revenue and earnings, but pay dynamics have not yet triggered a classic wage price spiral. It helps explain why, despite multiple macro scares this year, corporate earnings revisions are still drifting higher rather than rolling over. The challenge is that inflation is refusing to fall back to target. Upcoming consumer price data are expected to show headline inflation around 4.2% year-on-year, the highest in roughly 3 years, while core personal consumption expenditures are projected to grind up to about 3.4%. Core consumer prices may cool a touch month-on-month as rent pressures fade, but there is little evidence yet of a durable disinflation trend. Energy is the key swing factor that could push those inflation numbers higher. Global oil inventories have dropped from around 8 months of coverage in March to about 6 months now, and analysts see critical levels being reached between late July and late August if depletion continues. With shipping through the Strait of Hormuz still constrained and more vessels avoiding the Red Sea, physical supply risks remain live. In a genuine shortage, some see crude prices spiking toward the $125 to $150 range, a level that would be very hard for monetary policy to fully offset. Against that backdrop, the change at the Federal Reserve matters. Kevin Warsh is widely expected to steer the committee in a more hawkish direction, and several houses now talk about reversing previously assumed 2025 insurance cuts and even delivering multiple hikes, including one in December. Market pricing is unusually split, with options implying roughly equal odds of an additional percentage point of tightening or no move at all, highlighting just how wide the policy uncertainty band has become. In rates, the curve is flattening as front-end yields drift higher on hike expectations while long-dated yields hover around the 5% area. Policymakers appear comfortable using elevated long-end yields as a brake on equity exuberance, and some suggest those yields could move higher if needed to cool momentum. Even if oil prices ease temporarily, several strategists expect high yields to persist in both the U.S. and Europe, driven by ongoing supply pressures and heavy fiscal deficits. That yield backdrop creates a genuine alternative to equities for the first time in years. High-quality bonds and even long-dated investment-grade credit are offering yields in the 5 to 6% range, while free cash flow yields on many equity indices lag long treasuries. It is no surprise that municipal bond funds are seeing some of their strongest inflows in decades, and that more global investors are adding exposure to shorter-dated rates as a way to lock in income while policy is still tightening. Putting this together, equities are operating in a macro regime of strong nominal growth offset by intensifying policy risk. Credit spreads remain tight and volatility, while higher than 2 weeks ago, is far from crisis levels, which suggests the system can probably handle somewhat higher rates. The open question is how far yields and oil can move before they start to bite into valuations in a more material way. That tension sets the stage for what is happening inside the equity market itself. On the equity side, the earnings story is still doing much of the heavy lifting. Across major indices, profit forecasts for this year are running above 20%, with expectations for mid-teen growth again next year and a notable upgrade for 2026, where some estimates have jumped toward 25%. However, that longer-dated surge is driven disproportionately by a small cluster of large companies, which raises obvious questions about how durable it really is. Headline indices also hide a lot of internal churn. Only around a fifth of S&P 500 constituents are outperforming the index, and barely 3% are sitting at fresh 52-week highs, leaving investors heavily reliant on a handful of megacaps for performance. At the same time, there are days when the S&P closes lower, even though more than 370 of its names are actually up, because weakness in big tech and semiconductors overwhelms broad-based gains elsewhere. Some risk indicators are starting to push back against the bullish earnings narrative. One framework from Bank of Murray Securities has about 70% of its bear market signals flashing red, and measures of risk appetite have dropped more than 25% over the last few sessions, a pattern that has historically preceded outsized one-month drawdowns. Yet credit spreads remain tight, with high-yield spreads near 2.65 percentage points, hinting that corporate funding conditions are still very manageable. That disconnect is feeding a notable change in leadership. After a long stretch of tech dominance, recent action shows 82% of the top 50 S&P performers year-to-date now trading lower, while about 65% of the bottom 50 are higher. Flows are rotating toward value and quality, with sectors like consumer staples, healthcare, real estate, and financials posting solid days, even as the technology sector drops nearly 2%. Smaller companies are participating too. The Russell 2000 has outpaced the S&P 500 this year, returning roughly 16% versus about 8% for large caps, helped by improving earnings profiles among domestically focused names. Defensive areas like healthcare and financials are described as underowned and trading near historically low valuations, making them natural candidates for those looking to diversify away from stretched semiconductor and mega-cap tech exposure. Positioning adds another layer. There are aggressive short bets in U.S. equities running alongside extended long positions in technology benchmarks, which means that any negative surprise on inflation, policy, or earnings could trigger a painful liquidation on both sides. Volatility indices have lifted from the mid-teens into the high teens and low 20s, signaling more two-way risk, but not yet outright stress. The key question is whether the current rotation broadens into a healthier, more diversified bull phase, or marks the start of a more defensive regime. The center of gravity for equity narratives remains the artificial intelligence and technology complex. U.S. capex is in one of its strongest upswings in 2 decades, much of it directed at data centers, chips, and network infrastructure. China is adding to that impulse with plans to invest around $300 billion over 5 years in data center build-out, and recent Chinese export data showed overall shipments up about 19% year-on-year, with chip exports more than doubling, reflecting global demand for AI hardware. That strength has produced dramatic moves in semiconductors. Equity gains have recently been concentrated in memory chip names, to the point where some now look overextended after a rally described as a sugar high. The Philadelphia Semiconductor Index has seen intraday swings of nearly 9% to the downside, followed by more than 5% rebounds, and there have been sessions where the tech sector fell close to 2%, dragging the broad index lower, even as most other sectors advanced. Within AI, the market is increasingly drawing a line between core enablers and more speculative plays. Names like NVIDIA, Micron, and Microsoft are viewed as relatively better anchored by earnings power and scale, while smaller semiconductor, optical, and nuclear-related companies with high valuations are seen as most vulnerable if capital rotates toward new offerings. Recent corrections in stocks such as Micron, AMD, and Intel, each dropping around 7% on some days, show that even core names are not immune when sentiment swings. The AI supply chain itself is another source of dispersion. NVIDIA has reportedly secured a dominant position in the optical connectivity stack by locking up key indium phosphide capacity, creating multi-year supply constraints for other hyperscale data center operators. Companies like Amazon, Meta, and Microsoft are facing delays to their AI hardware roadmaps because of limited access to these components, and while suppliers such as Lumentum are trying to ramp output, New capacity from facilities in places like North Carolina is at least 2 years away. All of this is unfolding just as liquidity is about to be tested by a surge in equity supply. Large established technology firms including Alphabet, Microsoft, Amazon, and potentially Meta are lining up sizable equity offerings over the next 6 months, adding hundreds of billions of dollars in new paper to a market that is also digesting heavy bond issuance and tighter monetary policy. With cash balances not especially elevated, many institutional investors may fund participation by selling existing positions, particularly in technology, reinforcing the recent swings in sector leadership. On top of that, the private AI champions are coming. Upcoming mega listings for SpaceX, OpenAI, and Anthropic are expected to raise around $200 billion this year, compared with roughly $43 billion last year across the broader IPO market. SpaceX, for example, is targeting a $75 billion raise at an equity valuation near $1.8 trillion, with pricing around $135 per share and potential fast-track inclusion in major indices after recent rule changes. Early indications show demand more than 10 times oversubscribed, especially from retail investors eager for AI infrastructure exposure. That enthusiasm is a double-edged sword. Because cash on the sidelines is limited, raising money for these very large deals likely means selling something else, and many expect that something to be recent winners in chips and mega-cap tech. History also warns that excitement at the offer does not guarantee smooth performance, with analysis of top tech IPOs over the past 15 years showing average first-year drawdowns of around 55%, even when the long-term growth story remains intact. Beyond equity, private credit is now deeply involved in funding the AI build-out. A $35 billion financing arranged by Apollo and Blackstone to support chip purchases includes investment-grade tranches backed by Broadcom that yield about 8.5%, and roughly half of the deal is being syndicated to other institutions. That structure underlines strong appetite for safer AI-related credit risk, but also highlights just how capital-intensive the ecosystem has become, with implications for free cash flow, leverage, and ultimately equity valuations across the supply chain. The takeaway is that the AI theme is far from over, but its market expression is evolving quickly. Capital scarcity from central bank tightening meets a wall of new issuance, regulation, and supply chain bottlenecks, all of which argue for wider dispersion between winners and losers inside technology. That sets the context for some of the most important stock-specific stories away from the pure AI leaders. One of the most closely watched stories is Apple's latest push into AI. The company has unveiled a revamped Siri assistant, including integration with Google's Gemini model, and is signaling a focus on rolling out features ahead of the holiday season, potentially alongside a new foldable phone form factor hinted at in upcoming iOS updates. Strategists see these features as reinforcing Apple's ecosystem and supporting premium pricing over time, particularly because the firm is not taking on the massive capital outlays that other hyperscalers are shouldering for AI infrastructure. Markets, however, are not giving Apple a free pass. The stock slipped about 1.9% after the announcements, a sign of investor skepticism about whether Apple can truly compete at the cutting edge of AI. Delays to launching the new Siri in the European Union, tied to Digital Markets Act compliance, and the absence of an initial rollout in China mean the company's two crucial regions will not see the upgrade at launch, tempering expectations for an immediate boost to device demand. Further down the AI value chain, there are signs of strong demand for infrastructure enablers. Shares of Applied Digital jumped more than 10% after it secured a 15-year lease with an AI hyperscaler, underlining how data center landlords and power-hungry infrastructure providers can benefit from the capex wave. Private equity groups like KKR are also monetizing adjacent plays, with recent exits such as a 15 times capital return in data center cooling, showing how operational value creation and targeted M&A can unlock high multiples in this environment. Healthcare is another area where stock-specific news is intersecting with the broader rotation into defensives. GSK has agreed to buy U.S. oncology player Nuvalent for about $10.6 billion, a move that knocked the share price lower by around 3.5% as investors digested the rich valuation. Management expects the deal to be accretive to core earnings per share by 2029 and to strengthen the cancer pipeline, which fits a wider industry pattern of paying up today to address long-term growth gaps. AstraZeneca is pushing forward in another key healthcare growth theme, obesity. Its experimental oral obesity treatment has delivered efficacy and tolerability broadly in line with leading competitors, supporting progression to phase 3 trials and the potential for use in combination with other company therapies. These moves show why many see healthcare as a sector offering both defensive characteristics and long-duration growth optionality, especially as valuations are still relatively undemanding compared with crowded tech names. In financials, consolidation in Italy is drawing renewed attention. Intesa Sanpaolo has launched a €36 billion bid that could reshape the Italian banking landscape and create a top-tier European institution. The structure includes planned divestments to satisfy antitrust concerns, and the finance minister's signals of non-interference reduce political risk, potentially paving the way for further private sector deal-making as banks use higher rate-driven profitability to pursue scale. Together with under-owned valuations across European financials, these developments illustrate how leadership pockets are emerging well beyond the U.S. tech complex. Stepping back, the equity story right now is a balancing act. On one side, you have an unusually strong earnings and capex cycle anchored by AI and industrial spending, plus a still resilient labor market. On the other, inflation is drifting further above target, oil remains a wild card, and the new Fed leadership is leaning more hawkish, with markets debating whether we get multiple hikes or none at all. Inside equities, leadership is rotating away from a very narrow mega-cap tech core towards small caps, healthcare, financials, and other value and quality names, even as AI remains the dominant structural theme. The coming wave of big tech issuance and mega AI IPOs such as SpaceX, OpenAI, and Anthropic will test market liquidity and could force significant reallocations across technology, while company moves at Apple, GSK, AstraZeneca, and Intesa Sanpaolo show how idiosyncratic stories are increasingly driving performance. What matters next is how upcoming inflation prints, central bank communication, oil inventories, and the execution of those large deals interact with already narrow market breadth and stretched parts of the AI trade. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.